Hey everybody, I'm Fabian Calvo, founder and president of the real estate investment firm, The Note House, and creator of the Resourceful Real Estate Academy. And many of you have been asking me great questions. Remember, you could always email me, fabian@resourcefulrealestate.academy.com, or visit our Facebook page, which is in the link where I sent you this video. And you can ask me questions there, post questions, comments, concerns, whatever is on your mind. I answer them all personally myself. So, downside risks to real estate investing. It's a question I get often. People that are, just starting out, and they're like, yeah, I agree, Fabian, that the economy's really changing. There's a lot of, things happening. But at the same time, I don't want to get into something that is going to potentially expose myself to some kind of massive downside risk. So what are the potential risks involved in real estate investing? Well, I want to address those. I made a list. I came up with several of them. And there could be more. I think these are probably the main ones. And I want to talk about what they are and also how my course, or how educated real estate investors in general can not feel the consequences of these, or should I say, really limit the risk of these potential downside risks and minimize them to as much as you possibly can. Because remember, in any investment, there is a risk. Now, there are certain types of investments or certain ways that one can invest where you can minimize the risk and make it virtually risk-free. Real estate, especially after the crash we had in 2008, is known to be something that's very risky. Before that, though, people were like, they really didn't have that many problems if you get until, the savings and loan scandal where real estate prices were affected again. Or when there was a rapid surge in interest rates, But for the most part, people thought real estate was a stable investment or stable asset class. But if you look back in history, there's been fluctuations all the time. What separates, I believe, educated investors from all the other investors that lose money is just that. They're educated. They know the driving factors of what drives the real estate market. Back during the tulip mania, in the Netherlands, when tulips were like the big craze, like I think in the 1600s, where you had the blacksmith leaving his job to go sell tulips, buy and flip tulips on the auction block. You had a lot of people that weren't educated. They were herd mentality. That's what we saw in 2008. All the effects of the herd mentality. All these shows on TV about how people were flipping money, making money, flipping homes. Making money, and how great it was, and people driving around in Ferraris and 60 Minutes exposés on people that had to come from nowhere and made riches, all because they were investing in a market that was rapidly appreciating. Well, that's pretty easy to do. But educated investors know that there are simple principles and tactics and strategies that you could implement in up markets, down markets, markets going sideways, and you could make money, not just in real estate investing, but in any other asset class. So the number one real estate the number one downside risk that I could think of, and really one of the biggest misconceptions about real estate, is that you have to take on debt to buy it. Now, certainly somebody who takes on debt and takes on a lot of debt is exposing themselves to the next downside risk, which is market fluctuations or markets that may suddenly collapse, like we saw in 2008. I remember personally having some condominiums that I was selling, and I was selling them, and then all of a sudden, within about a month, everything just stopped. No more phone calls, nobody buying anything. And so it could happen pretty quickly. In the 80s, late 70s, 80s, interest rates quickly went up in a very short period of time. They went from like 7 or 8 or 9 to like 16, 17, 18 in a very short period of time. So those are definitely downside risks. But if you educate yourself, for example, on interest rates, if you agree like I do that we're in a position where the Federal Reserve can't raise interest rates or the whole entire economy would collapse, you believe that, hey, we still have at least several years for this particular cycle to play itself out regarding real estate. And what I mean by that is that if you look at rates where they're at now, let's say they're close to 3% or about 2.65, I think is where the 10-year was. The 10-year was much higher than that in 2011. But prices were still recovering and people were still flooding the market with investments. Certainly the rates were much higher during the boom years when real estate market was going crazy because the banks reduced or basically took away all the lending guidelines and anybody could get a loan. I think that's where we're headed, and for real estate investors to play it right, that could be a big opportunity. But back to downside risks. Too much debt is certainly one. If you take on too much debt and keep taking on too much debt, thinking that the only thing that's going to save you is real estate markets appreciating, well, that's a bad idea. But if you're being conservative with any debt you take on, for me, I take on barely no debt, or at least I'm not responsible for any of the debt that I do take on if there's a downside risk. That's what people need to do. That's what educated investors need to do. Taking on debt isn't a bad thing if you do it correctly and you do it in a way where your loan to value is really, really conservative. For example, if I'm buying a $100,000 property and I'm going to maybe take out a loan of, let's say, $50,000 to buy it, or maybe I'm going to take out a loan of $100,000 to buy that $100,000 property, but it could be that that $100,000 property is worth $200,000. And so I'm getting 100% financing for a property that's worth double what I'm paying. In the worst case scenario, if I go back and I look at where were prices when things collapsed in 08, let's say that $100,000 property that's worth $200,000, but I'm buying it for $100,000. Let's say in 08 it was trading at $120,000. Well, I could still say, okay, well, I could still finance this thing 100% and still do reasonably well, even if there's a big correction. But here's another thing, is that I don't even advocate taking on debt long term. All the investments that I do, about 90% of them, are buy and resold within 30 days. How do I not get stuck with properties? Because I have buyers and investors lined up for those properties before I even take ownership, if I even take ownership. In fact, a lot of the strategies that I talk about in the course don't even require you to take on debt or to even take title to these properties or become a landlord in order to monetize the deals that you're able to find. In essence, the risk there is pretty much zero. But it just depends how you want to play this market. And it depends how much education you want to get in this market. So we've covered interest rates surging, we've covered debt, we've covered the market's collapse and how they can happen suddenly. Here's a few other things to consider. One of the ways that people buy real estate with no money is to buy it with investors' money. And you could take on a bad investor. That could be a sucker, he could be a jerk, he could be, whatever. And he could try to sucker you out of a deal, or it could just be a bad falling out on partners. So know who you're getting into business with. Partner with people and make sure that the worst case scenario is talked about. Like, hey, what happens if meteors start to rain down and destroy the piece of property we buy? Yes, we have insurance that'll take care of it, but nonetheless, you get the point. What's the worst case scenario you could have? And think about that. And kind of play it out. Make sure you're partnering with people that know what they're doing. And here's another one. Buying a property that could be a potential money pit that you as a landlord have to take calls for leaking toilets at 1 in the morning, or that the property is just a total disaster and you have to put way more money into it than you thought. Well, again, I probably renovate less than 10% of the properties that I buy. I just resell them. I resell them to local investors. I become really good at finding really, really good deals and selling them to investors in that particular marketplace. That's where you could add value to this market without taking on any risk whatsoever, or should I say very, very little risk. I hope this video has been of informative to you. It's helped you understand, what are the risks you're getting into and what are the ways that you could avoid these risks. Remember, if you have any questions at all, don't hesitate to email me, Fabian@resourcefulrealestateacademy.com. For all my clients of Resourceful Real Estate Academy, I offer full email support, so I'm there with you every step of the way, personally answering your questions as you're exercising the project and the program and implementing your own investment structure that you set up. Thanks for watching. I'm out.